Welcome to our exploration of how money is created. We'll dive into common misconceptions, the modern process, and the role of central bankers in managing the money supply. Let's get started. If you were to ask 100 people how money is created, nearly all would say that the Federal Reserve just ramps up the printing press and somehow pumps it into the economy. Furthermore, it probably didn't help much when Milton Friedman coined the term helicopter money as a reference to a monetary policy where a central bank directly distributes money to the public, often through direct payments, tax cuts, or spending increases to stimulate the economy. Friedman's thought experiment, introduced in 1969, illustrated this concept by imagining a helicopter dropping money from the sky. The idea is that this extra money would boost consumer spending, ultimately increasing economic output. However, since the United States went off the gold standard in 1971, a vast majority of cases, around 97% of new money is created in our modern money system, through issuing debt or quite simply by taking out a loan, whether it's for personal consumption or capital for a business. As such, an individual or a business goes to a bank for a loan. The bank gives them the money if the bank has enough reserves. The result is new money that works its way through the economy. From there, the bank makes a couple of journal entries. This money in essence is created out of nowhere. However, when loans are paid back, the opposite happens. The bank keeps the interest on the loan, but the principal is destroyed and is no longer in circulation. The goal of central bankers is controlling the money supply by having the flexibility to increase or decrease money when needed. From there, retail banks can create money by issuing loans to customers. However, there are regulatory constraints to this process, as banks must hold a certain percentage in reserve. These reserve ratios are modified every few years by the administrators of the bank for international settlements, of which they publish the Basel Accords. Basel III had set the reserve rate at 8%, but Basel IV has set this reserve ratio to 10.5%. There are other factors that come into play in this reserve ratio, such as the liquidity of the reserves. Conflicts usually ensues, as bankers prefer lower ratios. However, regulators prefer higher ratios to help mitigate against a potential banking crisis. So in other words, Basel wants banks to increase the amount of money that they cannot lend, therefore reducing bank profits, but their risks are lowered for themselves and the general public. Lending operations have had a checkered past in the United States, from bank failures to discriminatory practices. African Americans and women were often shut out or given predatory loans. Over the past 50 or so years, the amount of new money that has been created has trended nearly straight up. In the United States, there was around $67 billion worth of U.S. currency in 1972. But now there's around 2.37 trillion. However, coin and paper only account for about 8% of all the dollars in circulation. The remainder are line items in a ledger or electronic blips on a computer screen. The way an economist historically viewed the U.S. money supply was to break it down into the M1, M2, and M3. M1 being currency outside of banks, checking accounts, and other liquid deposits like savings accounts and money market accounts. It represents the most readily available and easily accessible money for transactions. The M2 money supply is a broad measure of the money supply, including everything in M1 plus savings deposits, time deposits, and balances in retail money market mutual funds. The M3 money supply encompasses everything in M2, plus large time deposits, institutional money market funds, and repurchase agreements. M3 is considered less liquid than M1 and M2. because it includes assets that are not readily convertible into cash. However, the M3 money supply measure was discontinued by the Federal Reserve on March 2006. The Federal Reserve determined that the costs of collecting and publishing M3 data outweighed the benefits, as M3 did not provide additional information beyond what was already captured in M2. While this increase in money supply may appear to be a good thing, the fact is, all this money has been a disaster for the poorest Americans. They have often been shut out of this trend, and therefore their purchasing power has diminished over this half-century. Therefore, the saying that the rich get richer while the poor get poorer remains true. The nearly unavoidable result of the current banking system is the affluent can get access to cash, and therefore are much more likely to grow their wealth over time by investing in assets like real estate, stocks, bonds, and limited partnerships. The poor and working class, on the other hand, are continually being left behind. While this increase in money supply may appear to be a good thing, the fact is, all this money has been a disaster for the poorest Americans. They have often been shut out of this trend, and therefore their purchasing power has diminished over this half-century. The nearly unavoidable result of the current banking system is the affluent can get access to cash, and therefore are much more likely to grow their wealth over time by investing in assets like real estate, stocks, bonds, and limited partnerships. The poor and working class, on the other hand, are continually being left behind. Since the 1980s, interest rates have steadily trended downward. On the surface, this is great news. Loans are cheaper, and therefore a borrower can borrow more money cheaper. The reason being is most budgets are typically set to be able to afford the repayments on a monthly basis. A great example being a mortgage. Typically, when interest rates are lower, house values increase. And when interest rates rise, house values tend to fall or stop appreciating. This is because most people, when they're borrowing, must decide how much they can afford on a monthly basis. When interest rates are low, they can borrow a lot more money while staying at the targeted monthly payment. When interest rates are high, they cannot get as much money if they want to stay within a targeted monthly payment. So therefore, most people would be excited to get low interest rates because they know that they can borrow more money. On a micro level, higher interest rates mean the middle class is going to pay more for car loans, consumption loans, and even mortgages and other debt. Now that's why a lot of people will argue for lower interest rates, which means cheap money to help the middle class consumer. However, on a macro level, in the long run, just the opposite happens. Low interest rates cause asset bubbles. This means the wealthy can get access to large amounts of dollars through loans that the middle class does not have access to, and they can drive up asset prices such as houses, art, and even cryptocurrencies. Additionally, low rates will incentivize public companies to conduct massive stock repurchases instead of reinvestment or hiring more workers or increasing worker pay. Furthermore, they drive up stock prices, which means the middle class will be fired when stock prices naturally go back down. Ultra-low rates also mean pension funds will be severely underfunded because more monies are needed to be put in to cover the long-term needs of the funds. Basically, our long-term social contracts for millions of hardworking families were broken by low rates. Currency stability plays a crucial role in the economy, allowing for predictable pricing and long-term planning. It supports the smooth functioning of financial markets and helps maintain consumer and business confidence. When a currency is stable, it effectively serves as a medium of exchange, a unit of account, and a store of value. These functions are essential for economic transactions and the efficient allocation of resources. A stable dollar does not necessarily mean lower interest rates, while a strong dollar can sometimes be associated with higher interest rates. The relationship is not always straightforward and depends on various economic factors. The Federal Reserve's monetary policy, which includes adjusting interest rates, is driven by its dual mandate of price stability, which is a fancy way of saying they are mandated to control inflation and maximum employment, and the dollar's strength is just one factor. From a historical perspective, a stable currency, like the dollar, is the exception, not the norm. A stable dollar is influenced by factors like government stability and its policies, international economic conditions, and the overall health of the U.S. economy. While increased money supply can contribute to a stable dollar in some contexts, it doesn't directly drive it. As such, the stable dollar has allowed Americans to measure value and transfer it through both space and time. Will this last forever? Probably not. Especially if America were to fall prey to a dictator type who has fascist leanings. The beginning of 2025 was proof as many in the international community started to pivot away from the stable US dollar. To understand this concept of stability, one should understand what makes the dollar a useful currency. The currency needs to have three main functions: unit of account, medium of exchange, and a store of value. A unit of account is when the goods or services available in a country are priced using the same form of money. In the United States, the dollar is the only true unit of account. For example, if I pay for a service and it costs $100 a month in 2015, and now it is double the price, I understand exactly how much this service increased. The medium of exchange refers to being the actual tool used in a trade for goods and services. In ancient societies, before the Lydians invented coins around 600 BCE, some places had several mediums of exchange, with silver being the most preferred. Besides the rise of cryptocurrencies, in Europe the euro is the medium of exchange, while in the US, the dollar is used. However, it's not uncommon for the dollar to be used in international trade, even if it doesn't include a US entity. Therefore, it's common for two non-US entities to use the dollar in the deal. As such, the medium of exchange should be accessible and known as an accepted medium, have a constant usefulness or utility. It should be easily recognizable, and be resistant to counterfeiting. A store of value is an asset that retains its value over time, allowing it to be saved, retrieved, and exchanged in the future without significant depreciation. It essentially ensures that wealth held today will not lose its purchasing power over time. The ability to store value is crucial for a functioning economy, as it allows individuals to save for the future, engage in trade, and maintain their wealth. Numerous currencies have failed as a store of value due to hyperinflation. A base level of demand, combined with a limited supply, makes for the best stores of value. This would mean that they would hold value into the near future, and therefore cause that form of money to be more desirable. Once the store of value function is realized, a currency becomes more accepted in daily transactions. In this section, we're going to explore the fundamental properties of money. These properties are essential for any asset to function effectively as money. When you put it all together, money should have fundamental properties. These properties are divisibility, meaning it can be divided into smaller units. This is why commodities such as livestock were never good uses as money. Money should be durable, meaning it can withstand repeated use and exposure. In ancient Babylon, when people stored grain in the temple, they would get a receipt. This receipt could be transferred and used as an early form of money, backed by certain grains. The issue is grains are durable. They can degrade or get eaten by rodents. Money must be portable. which means it can be easily moved from one place to another. China used to use copper coins as a currency. Copper coins were useful for small transactions, but they became cumbersome and heavy for large amounts, making them difficult to transport for extended distances. This issue, combined with the increasing demand for currency as trade expanded, led to innovations like flying money, which were bills of exchange, and eventually the development of paper money. It was much easier to carry paper that represented 100 pounds of copper versus actually carrying the 100 pounds, especially if the person needed to travel great distances. Money needs to be fungible, meaning it should be interchangeable with any other unit of the same denomination. For example, all dollar bills are the same. There are no differences between people's dollar bills, ensuring that a dollar bill is worth the same as any other dollar bill. An example of a currency that wasn't very fungible were the original Lydian electrum coins, because the gold and silver content varied with each coin. So one coin could be 55% gold and 45% silver, whereas another coin might be 50% silver and gold, meaning that the coins carried a different value. Money should be scarce enough to maintain its value and prevent inflation, but not so scarce that it can't be used in everyday transactions. This is why silver was the preferred currency for millennia, and why copper coins were never a great use as a currency due to their excessive supply, and why, when certain currencies experience hyperinflation, people will look for alternatives, such as the US dollar, to use in transactions, even if it's a country on a different continent. These factors are a main reason why so many cultures and societies turn to silver and gold as a currency. However, many societies didn't have access to these metals in a large enough supply, so they turned to other commodities such as huge stones shaped like discs on the island of Yap, or even deerskins in the colonial days of the United States, hence the nickname for dollars as bucks. The Maya and Aztec civilizations used cacao beans as a form of currency. Cacao beans were a valuable commodity, and they were used for trade, taxes, and even to pay tribute to the nobility. However, gold and silver allowed the societies that used them to best store wealth over time. Silver was the dominant currency for millennia. It really started in Sumer and Babylonia as they moved away from using grains as currency to the use of silver ingots. Silver was almost exclusively the English currency until 1344, until the gold noble was put into circulation. However, silver remained the legal basis for sterling until 1816. Mesopotamians have used metal money in the form of metal ingots for over 1,000 years by 600 BCE, but the process was inefficient as the traders would need to weigh out the ingots for each transaction, and they weren't very divisible either, so there would have to be some manual work to divide the ingots down even further. In Lydia, an empire residing near the western coast of Anatolia, they were able to extract and produce small ingots that were originally electrum metals, which were naturally occurring mix of silver and gold metals. It is said that they were basically nuggets that were traded. Whether it was intended or not, the thing that made these nuggets so effective was the fact that they were easier to transport and conceal from potential thieves. But more importantly, they were easily subdivided to the point that theoretically they would be worth a few days' worth of labor or worth a portion of a farmer's harvest. The issue with these electrum nuggets was the alloy of gold and silver that varies in its natural state between 65% and 85% gold. In addition, the traders really didn't have the ability to weigh or use a touchstone to tell the percentage with any precision. The ancient Lydians goldsmiths took these nuggets and turned them into the world's first coins. They initially produced these coins by pouring the molten metal on a plate. Over the years, this evolved into pouring the metal into a mold, creating blank discs, which were called flans. Once these blanks were cooled, they would be struck with their symbol by a hammer. which would allow the user to know the origin of this coin. They weren't very sophisticated at first, as they were just basic round shapes of metal with basic stamps. Stamping the coins with an official seal conferred official value to it, which set it apart from all other tokens that had been used in trade previously. By making these coins a standardized size and weight, and by stamping on them an insignia that confirmed their worth, to even the illiterate, the kings of Lydia exponentially expanded the possibilities of trade into and out of Lydia. So therefore, one did not need to be able to work a scale, or even own or possess a scale to buy anything in a market. And, as a result, commerce was allowed to proceed much more rapidly and honestly. The makeup of the coins was initially made from electrum, an alloy of approximately 55% gold, 45% silver, and a tiny amount of copper. The copper additives were designed to give the coins more durability. What other states realized was their coins were portable, hard to counterfeit, and had some kind of value, whether inherently or by authority of the government for trade. With standardized weights, coins eliminated the time-consuming problem of weighing and verifying its content. For that reason, they quickly became a universally accepted means of trade. Like all the ancient coins that came after it, coins represented units of weight, rather than a specific monetary value. For example, a stater was an ancient coin typically of Greek or Lydian origin, meant that which balances scales in ancient Greek. Our modern English word of money came from the Latin word monere, which means informing to announce the value of the metal weight of a coin. Eventually, our modern version of the word coin will come from the French, when they use the word to describe the die stamping the coin. And the word bank will be derived from the word bench, because the money changers in medieval Italy sat on benches when performing their banking operations. Every coin should have a face value higher than the cost of production. This concept of production versus face value is known as seigniorage, which means governments literally can make money by creating money. The Lydian government generally assessed the face value of coins at a little more than the underlying value of the weight metals in the coins. Therefore, the local and foreign markets would have traded coins that were in fact overvalued in comparison to the underlying weights. Thus, the government was able to generate a profitable spread between the underlying ingots and accepted value of the coins. To appease this controversy, the Lydians struck the coins with religious symbols to further induce their usage, because now you're paying tribute to the gods. Consequently, Lydia was the first state to circulate official coins. India or China also developed coins independently of Lydia. However, most historians believe Lydia had minted coins first. These Lydian coins were created to authenticate payment, resulting in an increased efficiency, as traders would no longer need to weigh out silver or gold. Croesus, the last king of Lydia, made significant advancements in coinage. He introduced a more refined and pure gold coin known as the Cresid. This innovation marked a significant leap forward in the history of money, setting a precedent for future civilizations. The next great leap forward in coinage came under the reign of Croesus, who ruled Lydia from about 560 to 546 BCE. He was so wealthy that the expression rich as Croesus lasted for thousands of years, as he was known to have been the richest man in the world. About 10 years into his reign, Lydian metallurgy advanced to the point that they developed a way of separating gold and silver out of electrum in a long chemical process in a furnace. As such, it appears that he was in fact the first Lydian king to issue separate gold and separate silver coins. From then on, his royal seal on his coin certified a fine silver or gold metal. Afterward, the foreign merchants began to accept the coins at face value, without any sort of discount. Each silver or gold coin had a precise value and weight specified by law. Additionally, the Lydian king fixed the values of gold versus silver, as an ounce of gold had a stronger value than an ounce of silver. So therefore, 1 gold weight was worth 10 silver weights. In effect, the Lydians practiced bimetallism, where the government circulated both silver and gold coins separately. Consequently, the king had to have a good understanding of the aggregate supply versus demand for each metal. For that reason, he had to make sure to keep a proper balance between circulating the right amount of gold versus silver coins. Since the Lydian king had increased the circulation and had a monopoly over the production of coinage, he was able to enforce strict compliance of the coins. In fact, the early coins would later be known by historians as Cresids, named after Croesus. As such, he might be one of the most important historical figures when it comes to international monetary policy. The unintended consequence was that he expanded international trade forever going forward. This all led to his legendary wealth, as in the saying, "Rich as Croesus." The term goldsmith was often used as an umbrella term for those who worked with precious metals, including gold, silver, platinum, and palladium, while the specific focus may have varied, with some specializing in jewelry and others in hollowware or larger silver objects. The fundamental skills and tools often overlapped. Ancient Greek goldsmiths took their cue from the Lydians and devoted themselves to improving coins, so that they were as easy to identify and difficult to counterfeit. Despite its name, goldsmiths worked with both gold and silver. To achieve this, they adorned their coins with original engravings. To stop thieves from altering their shapes, they created the graphela, which refers to the milled, or decorative edge, of a coin, often featuring a series of small beads, or denticles. It's essentially the textured border that surrounds the coin's main design. Slavery played a major part in the minting of coins. In fact, it's estimated that around 20,000 slaves worked in the Laurian mines in ancient Greece. These slaves were crucial for the mine's operation, including extracting, washing, and processing the silver ore. The silver produced in Laurian was vital for the Athenian navy and contributed to Athens' rise as a naval power. By 546 BCE, the Athenians also used slaves as goldsmiths, who minted the tetradrachm, which quickly became the most popular currency in the Mediterranean and was widely circulated for almost 6 centuries. The Laurian mines, located 30 miles south of Athens, produced about 2.5 tons of silver. That silver was used for minting coins featuring an owl engraving representing the goddess Athena. Before the owl coins, the first Greek coins appeared in Aegina around 600 BCE. Initially, coinage in Greece wasn't fully accepted on the mainland. However, it was adopted in other Greek regions, especially the Ionians, until Alexander moved into Anatolia and adopted their coinage. However, the rise of the local Ionian Greek coinage on Anatolia meant competition for the Lydians, especially due to the fact they were using pure silver, meaning the people that accepted Greek coins knew precisely the metal makeup, unlike the electrum coins. For example, in foreign trade, Lydian kings couldn't benefit from the full value of electrum coins. Accordingly, they would have taken a negative spread once the electrum coins reached other kingdoms. With that being said, foreign merchants underestimated the unknowable gold content of electrum. Coins with the inconsistent pale yellow color of electrum were downgraded as silver by neglecting the gold portion in the alloy. Merchants instead weighed Lydian electrum coins and compared their value to Greek silver coins, or fine silver ounces. Goldsmith banking in Europe was initially a place where people or merchants could take their precious metals and coins for safekeeping. Additionally, these primitive bankers would perform an early form of foreign exchange. In the late medieval period, bankers in northern Italy started to grow in size and influence as they expanded their money-changing business, in part because each city in northern Italy was its own separate country, with its own unique currency. These city-states also saw their local economies continuously expand since the bubonic plague. For a fee, they would swap coins from one town to those from another. Additionally, it wasn't uncommon for traveling merchants to set up deposit accounts with these bankers so that they could hold coins for the purpose of exchanging for another currency later. It was common for merchants to meet up at large-scale fairs that functioned as annual trade events. These were crucial hubs for buying and selling goods, particularly in the 12th and 13th centuries. These fairs were often held at specific towns throughout Europe. They offered merchants opportunities to expand their reach, acquire goods wholesale, and meet with traders from various regions. In addition, they would often use these fairs as a chance to settle credit deals they had established prior. Therefore, having money on deposit at a local bank made transacting at these fairs much easier, as they could pay off debts in specific currencies. Or if they received currencies, they could deposit their coins or precious metals at the local bank. The earliest deposit takers in London were often goldsmiths or artisans who made gold jewelry and candlesticks, and they were also money changers. They were influenced by the development of banking practices in northern Italy. Northern Italian city-states like Florence and Genoa pioneered sophisticated financial techniques and lending practices. These practices were emulated and therefore gradually spread to other parts of Europe, including London. Like the Italian coin changers, they had safe-keeping vaults where they stored their own silver and gold. The earliest record of deposit transfer payment emanates in Italy around 1200 CE. The initial system was rudimentary, in that if one person wanted to pay coins to another person, they both would go to these bankers, where they would weigh the necessary number of coins before the transfer. This system was inefficient, and that didn't include the risk in transporting the coins across town and back. Additionally, weighing the coins resulted in fees to both sides of the deal. At the end of the day, the payer's cash balance or charge on the banker will go down by the amount, plus transaction fees, and payees will go up by 100 ounces, minus transaction fees. By the 1400s, banks in northern Italy had evolved quite a bit, as bankers like the Medici family had issued deposit receipts that could be signed over, making them function like modern traveler's checks. They soon provided them in bearer form, which meant that they didn't require a signature to transfer from one to another, therefore acting as a currency. They could be transferred anonymously without bank involvement. This was unlike transfers of deposits, because they needed to be recorded in their books and records. In the mid-1600s, London goldsmiths issued banknotes. Banks also held fractional reserves against their total liabilities to the banknotes. Prior to the Glorious Revolution of 1688, England, like most monarchies at the time, faced a variety of financial challenges. They, like so many kingdoms, were chronically short of gold and silver for everyday transactions. Thus, it wasn't uncommon for transactions to occur without the use of metals or coins. Consequently, the English, like most Europeans, had to set up a workaround. The most common workaround was simply debt contracts, whereas the buyer and seller agreed to a payment at a later date. In England, a common way to track these debts was by using a tally stick. The reason being was the English people were generally illiterate, so the use of tally sticks provided a visual and tangible way to track debts and payments. While they were used in England, there is no definitive proof that they were widely used in Scotland. A tally stick had notches representing specific amounts with a description inscribed on the two sides adjoining the notched side. The stick was then split in half, with one half, known as the foil, going to the debtor, and the other, the stock, going to the creditor. When the debt was paid, the two halves of the tally stick were compared to verify the accuracy of the payment. These tally sticks were used for ordinary transactions, and they were also used to track tax payments and income. Tally sticks were used to record debts and taxes from the 12th to 19th centuries, but were discontinued in 1826. They would eventually be replaced by modern practices using paper ledgers and accounting practices. Unfortunately, many of these records on tally sticks were lost forever as they were often used as firewood. When people did, in fact, have coins, for security reasons, coins were often left in the safe in exchange for a receipt. Therefore, clients avoided carrying coins in their pockets, and when needed, they endorsed the receipt for payments. In reality, the people of England were doing what the Italian or Dutch had been doing for centuries. However, the English banks simplified the receipt a step further as the receipt was labeled with the bank's name, instead of labeled with the name of the account holder. Additionally, on the receipt was printed to the bearer, therefore creating the modern banknote. The banknote was exchangeable in coins that the bank specified on the note. Thus, the holder of the note no longer needed to be endorsed, because only the bank's name mattered. This meant transactions could happen faster and more efficiently, as the banknote passed from person to person until the sum of coins written on the note was claimed at the bank, having issued the note. In 1668, the first banknote was accepted in England as payment instead of coins. In 1704, paper notes were ratified in England as legal tender, which established the foundations of banknotes. However, these notes weren't for everyone because, in the early 1700s, only merchants, bankers, and the English government benefited from the services of the banks and their banknotes. Most classes of people were effectively excluded by the banking structure, as a majority of people only handled coins, especially token coins. Banknotes were labeled in silver weight, as most coins were convertible in silver or gold coins through the bimetallic ratio. The label of the unit of banknotes was often the pound sterling, rather than the shilling, because the shilling's value was too low for merchants who handled banknotes. They were typically issued in denominations of hundreds, tens, and single-pound sterling, allowing merchants to combine smaller denominations to represent larger amounts, such as 528 pounds sterling. This system allowed for transactions involving higher values and made it easier to manage large sums of money. Coins in circulation were primarily struck and labeled as shillings, not as pounds sterling of silver. Up until this point, the pound sterling was mostly used in accounting as ledger items because there was a shortage. Instead, most larger transactions would have been done through some sort of lending agreement until the counterparty was able to gather the money to settle the loan. It wasn't until banknotes were used that the average person could visualize pounds sterling for the first time. At the time, a shilling was worth 1/20th of a pound sterling, and a silver penny was worth 1/12th of a shilling. The silver sixpence of 6 pennies and the silver half crown of 30 pennies circulate likewise. Coins of lower value were copper alloy token coins, such as the halfpenny or halfpence. The principal gold coin was the guinea, which fluctuated around 20 shillings, as dictated by any adjustment of the bimetallic ratio. The name of Guinea came from the African origin of the gold at that time. This was a region of Africa that was extremely rich in gold. In fact, this is the region of the world that saw the rise of Mansa Musa's empire in Mali. There was so much gold in the region that many have said he was the richest man in the world. When he went on his pilgrimage to Mecca in 1324 to 1325, he spent so much gold along the way that it caused massive inflation. Mansa Musa's gold made its way to Europe as well. Mali's wealth, particularly its control of the gold trade, fueled economies across North Africa, the Near East, and Europe. Merchants carried Malian gold to European cities like Venice and Genoa, where it became part of the European commercial system. This gold was used to create coins in Europe and contributed significantly to the continent's economy. Centuries later, when Europeans like the English needed gold, they would go to the west coast of Africa for trade, in the hopes that they could bring back gold to the continent. By the time that banking was developing in England, all the coins were of a high quality known as sterling. For silver, it was 92.5% pure, and for gold, it was 91.6% pure. Since Elizabeth I, around 1600, the ratio was set at 62 shillings per 1 pound of sterling silver, measured in the troy system used for precious metals. 1 troy pound weighs 12 troy ounces or 5,760 grains. For that reason, 1 shilling was worth 1/62nd of a troy pound, or 1/62nd of 373 grams of sterling at 92.5% pure. Being chronically short on silver and gold was possibly the least of European concerns, because the continent was constantly at war with itself. These wars were very costly in terms of lives and money. England fought the French for 2 years, starting in 1627, and then another Anglo-French War from 1688 to 1697, as a direct response to the Glorious Revolution. Additionally, there was the Second Anglo-Dutch War, lasting 2 years in 1666. Moreover, they were also in the process of unifying England, Wales, and Scotland to make Great Britain. These wars and instability were part of an ongoing struggle since the days of William the Conqueror in 1066, when the Normans, who were effectively French Vikings, took over control of England that was run by the German Anglo-Saxons. And as such, money was constantly in short supply, because it was often used for offensive and defensive purposes. Sending troops in the Navy on campaign was extremely costly, and to make matters worse, there was nearly a decade-long civil war, from 1642 to 1651, that was driven primarily between supporters of the English monarchy, led by King Charles I, and those of the English Parliament. Therefore, during the 1600s, England was constantly on the brink of collapsing, and these wars were the result of a long-standing power struggle between the king and Parliament, fueled by the lack of money and resources from all these wars. And then there were the religious and political disagreements. Since the crown had rising debt and financial needs from these wars, the king had to increase taxation. The population and the Parliament were not on board with these tax increase proposals, which led to conflicts over financial authority and governance. The period was marked by economic difficulties, including inflation due to currency changes and a fluctuating agricultural sector. England was coming off a century of the Great Debasement in the 1500s. Additionally, by 1600, the mint had undervalued gold, so very little was sold to the mint, and then the gold was exported from England as the English got greater value abroad. Therefore, England's only fix was to change the relative values of gold and silver, and rather than appreciate the silver coinage, the king depreciated the gold coinage. As such, Queen Elizabeth I, who ruled from 1558 to 1603, inherited the severely debased coinage, along with chronic gold shortages, so her only recourse was to restore its value. She oversaw the withdrawal of debased coins from circulation, their melting down, and the replacement with newly minted coins of higher quality. Additionally, from around 1560 to 1630, there was a dramatic climate shift, as there was a worldwide glacial expansion, known as the Grindelwald fluctuation. The result was, temperatures were 1 to 2 degrees Celsius, or up to 3.5 degrees Fahrenheit lower than 20th century averages during this period. The lowered global temperatures meant poor harvests and subsequent food shortages, which raised social tensions and discontent among the lower classes. Furthermore, whenever there is a period of notable cooling, you can almost guarantee a plague of some sort will break out. This period was no different, as it was accompanied by outbreaks of a plague, famine, and other calamities. The financial issues were intertwined with political struggles, particularly with control over taxation, and financial policy was a significant point of contention that led to a breakdown in relations between King Charles I and Parliament, resulting in a civil war. Additionally, the monarchy was notorious for lavish spending habits, particularly under Charles II, who strained financial resources. The reliance on royal prerogative and patronage also added to conflicts with Parliament. The culmination of these factors, combined with issues of religious conflict, power struggles, and the growing influence of Parliament, led to the Glorious Revolution with the Dutch William of Orange. It was a largely bloodless transition of power, with William invited to invade England by Parliament to secure a Protestant succession and limit the monarch's power, resulting in the establishment of a constitutional monarchy in England, which aimed to limit the powers of the crown and enhance parliamentary authority over financial matters. The rise of the goldsmith was probably the unintended consequence of a poor government and international instability. Prior to the Glorious Revolution, in 1688, England, like most monarchies, was constantly in and out of war and had a shortage of money. As a result, England in the 1600s suffered from an irresponsible government, and by the second half of the century, its silver coins were constantly being debased. Thus, the coinage contained much less silver than they were supposed to. The debased coins were used to pay workers. As such, they felt they were being ripped off as their pay was short on silver content. Furthermore, everyday transactions in the local markets that should have been efficient and orderly often devolved into chaos as fistfights broke out over the silver or gold content of the coins that were passed to the seller. According to the historian Thomas Macaulay, almost nothing could be purchased without some dispute. Therefore, the interactions between buyer and seller resulted in haggling from morning to night. Contracts were signed that specified not just how much money was to be paid, but the total weight of the coins. Coins became less like money and more like lumps of precious metal. Additionally, an arbitrage market sprung up. Arbitrage is a financial strategy where a person seeks to make a risk-free profit by utilizing temporary price differences for the same asset in different markets. A person would buy an asset where it's cheaper and simultaneously sell it where it's more expensive, profiting from the price difference. In Europe, there were well-known price differences. Therefore, one could obtain an easy profit by taking full-weight silver coins out of England and trading them for gold in Paris or Amsterdam. As a result, even when the British Mint melted down the debased coins and issued silver coins, most people almost immediately took those coins out of circulation to go trade them for gold in another country. As such, England was chronically short of money, and something or someone needed to step up to get more money into circulation. Then, maybe by accident, goldsmiths may have inadvertently started to solve the money shortage problem and moved economies into modern banking. That's still with us today. To understand how goldsmiths became a crucial part in modern banking, it's worth taking a step back to see how the region of Great Britain had been ruled. The House of Stuart reigned in Scotland, and later in both England and Ireland, during the 16th and 17th centuries. The Stuart monarchs ruled either England or Scotland, or both. As trade increased throughout England and the rest of Europe, a new class of people known as the financial bourgeoisie emerged. This resulted in tensions between the new financial class and the traditional aristocratic institutions, as they felt they were being exploited by the financial class. This exploitation coupled with the king's reliance on the bourgeoisie for funding, spurred the need for regulated relationships between political power and economic power. The bourgeoisie, essentially the capitalist class, were seen as a source of wealth at kings. However, many of the monarchs were bordering on becoming kleptocratic rulers who often treated their country's treasury as a personal piggy bank, spending funds on luxury goods and extravagances as they saw fit. The new financial class was becoming a great source of this funding needed to support their ambitions and lavish spending. Before the Stuart kings for nearly 500 years, the mint had been a depository place for the elites, including the wealthy merchants. Since coins were prone to depreciation due to wear and tear, certain coins would be worth less than others. Therefore, not all coins were of equal value. Therefore, the officials had to weigh each person's deposit to get an accurate account of the metals on deposit. They recorded the deposit amount using a tally stick, which were notches on the stick to show exactly how much was in deposit, because England wasn't using paper to record transactions. These tally sticks served as a ledger and savings book for both the depositor and the mint. The secret Treaty of Dover was signed between Charles II of England and Louis XIV of France in 1670. Under this treaty, Charles II agreed to support a French attack on the Dutch Republic in exchange for secret payments, hoping to become financially independent of Parliament. The treaty also included a provision for Charles II to publicly declare himself a Roman Catholic, which he never did. In January 1672, the mint contained £1,328,000 sterling advanced to the king by the financial bourgeoisie, which included the merchants, bankers, and professionals. Like so many monarchs before and after, he ran out of money. In the process, whether it was stress or genetic, he appears to have had a mental breakdown and lost his mind, just as his father had done prior. He must have looked at the Tower of London and its gold and silver reserves and thought to himself that he has the divine right of a king, and therefore he probably viewed that money as his money, and therefore seized its assets, shutting out the rightful owners of the assets. This famous raid has been known in history since then as the Treasury Stop. Those assets belonged to some 10,000 people. Charles II tried to calm the nerves of the owners of the assets by stating that he closed the treasury, declared that the money he had taken would be withheld for only 1 year. However, he did not keep that promise, just like his other promises. Despite this seizure, the government paid 6% interest on the funds for 6 years, from 1677 to 1683, but stopped paying interest afterward. Furthermore, the assets were still seized during the next short reign of James II, and they still weren't paying interest. It was not until the Glorious Revolution which put William of Orange on the British throne that real compensation was a potential reality. However, the bankruptcy and ruin that followed the asset raid by Charles II was so widespread and disastrous that it resulted in the birth of England's national debt. England, therefore, was politically and economically very unstable during most of the 1600s. This instability had unintended consequences as modern London banking was inadvertently started in the 1600s. Since the Stuart kings, Charles I and Charles II were nearly kleptocratic rulers. The elites weren't very happy with this arrangement and sought to eliminate the absolutist monarchies. Before the Glorious Revolution, the English Parliament had limited to no power, as they were essentially functioned as an advisory committee, summoned and dissolved at the monarch's discretion. Furthermore, there was an extreme shift in the relations between the king and the wealthy upper classes when Charles I plundered the treasury of the government. The wealthy individuals who didn't lose their money rightfully got scared and looked for an alternative place to park their assets. The nervous wealthy merchant community moved their deposits to the Goldsmith money changers of London, as they were viewed as a safe and secure place. The transfers increased during the Civil War in 1642, as Goldsmith money changers took their valuables including jewels, coins, and precious metals as deposits. For short-term deposits, goldsmiths charged a small fee for accommodation. For long-term deposits of a year or more, they paid up to 6%. Whenever an individual stored their gold or silver, the goldsmith would immediately give the person a receipt. This concept wasn't necessarily new, because a form of this was happening in China, particularly Sichuan, 100 years prior. Furthermore, this concept had its roots that trace back to ancient Sumer, as the oldest known grain receipt, dating back about 4,000 years ago, indicated that the clay tablet receipt could be paid to the bearer. In other words, one could make a payment in Mesopotamia by passing the clay tablet to another. It didn't take long for people to figure out that they could just forward these receipts to another person or business. That person could forward it on to someone else, and then these receipts could flow through the economy until someone wanted to redeem gold or silver at the goldsmith. Therefore, the people in England started using their receipts themselves to buy and sell goods and services. At the outset, this was paper being substituted for gold or silver in their transactions. This essentially made gold or silver more portable, as one didn't need the actual metal. However, this did not expand the money supply. It only changed the form of payment. The goldsmith's next actions forever transformed banking and money supply, and therefore altered commerce both domestically and internationally. Since goldsmiths were storing quantities of gold and silver, they started to give people loans based upon the gold and silver they had in their reserves. Therefore, if one needed to get cash, they didn't necessarily need to have gold or silver to get it. They could just go to the goldsmith and get a loan that was backed by gold or silver. These loan receipts, backed by the metals, could be transferred to another person as a form of payment for goods or services. The person that received the loan had to sign a promissory note, which was a written agreement to repay the debt. These notes typically included the principal amount, interest rate, repayment schedule, and any conditions for default. It was a legally binding agreement between a borrower and a lender that outlined the terms for repaying money owed. As such, these goldsmiths issued claim checks began to circulate as money, allowing paper to be used for purchases. This increased the amount of money in England, effectively creating money from nothing. While goldsmiths were inadvertently solving the money shortage problem, around the same time, Sweden implemented something similar. The difference was, Sweden used copper, not gold or silver, as their money supply. The obvious issue was copper wasn't as rare as gold or silver, therefore copper wasn't very valuable, so the amount of these coins were quite massive. For example, the largest denomination of Swedish money was worth 10 dalers. The issue was, the copper currency was 2 feet long or about 60 centimeters and weighed 43 pounds or nearly 20 kilograms. In order to transport these coins, they needed to strap them on backs, like a heavy metallic backpack. The Swedes recognized that this was not an efficient system and something needed to change. Therefore, the Swedes created a bank to give them paper money in exchange for giant copper coins. Like the goldsmiths in England, the Swedish bank almost immediately started giving people paper money as loans. As such, Sweden was able to create money out of nowhere. The Chinese had done this nearly 1,000 years prior when they issued paper money backed by copper coins. Then, in the 11th century, the Song dynasty saw the rise of private merchants issuing their own paper currency to address copper coin shortages, especially in the Sichuan region. These notes were initially backed by reserves of coins and salt, but later by gold and silver. Therefore, the Chinese were the first to issue paper notes that were backed by copper coins. However, the Chinese did not issue loans based on these coins, or gold, or silver, or even salt. Therefore, the Chinese, while they invented paper money much earlier than the Europeans, they did not create money out of nowhere, like the goldsmiths in England or the Swedish bankers. Nearly a century later, in Germany, a goldsmith and money changer named Moses Amschel Bauer was getting his start as a kind of roaming peddler who had sold his goods in Hanover and along with numerous rural country fairs and festivals at countless rural fairs without much success. So, he decided to settle in Frankfurt, Germany in the Jewish quarter and opened a brick-and-mortar small shop in 1743. He put a red shield over the door that read Rothschild. From that shop as a small-time goldsmith emerged the most prominent international banking family of the century, and one of the most powerful families of speculators and moneylenders the world has ever known. To give you an understanding of what it means to create money out of nowhere, Niall Ferguson's The Ascent of Money explains it well. First-year MBA students at Harvard University play a simplified money game. It starts out with a central bank paying a professor $100 of money as a consultant. The professor takes that $100 and puts it into an account run by a student who is a retail banker. In his example, he states that the bank has to hold a 10% reserve ratio. Therefore, out of the $100, it must save $10 in reserve, and the other $90 can be used for lending purposes. Then, another student would borrow $90 from this reserve. In the meantime, the borrower of the $90 deposited it into her bank before using it to spend on something else. The bank still has a 10% reserve and therefore can lend out $81 out of that $90. Another student comes in and requests a loan for that $81. That student takes that $81 and puts it into her account at another bank. At the end of the experiment, the professor asks the class how much money is now in bank accounts from this original $100 that was given to the professor by a central bank. The original $100 would be considered M0 money, while the borrowed money would be considered M1 money. M0 represents the monetary base, which was the $100 from the central bank account. The M1 money is now $271. That $271 is the original $100 plus $90 plus $81. So in other words, that simple $100 quickly became $271. This is a simple way to show how fractional reserve banking works. This is exactly what the goldsmiths accomplished when they were lending gold reserves to borrowers. Of course, the reverse can happen if the banks start calling in their loans. Modern banks do what the British goldsmiths did nearly 400 years prior. To put it a different way from the money game at Harvard, an individual would walk into a bank to deposit money or have their paychecks directly deposited in a bank for safekeeping. The bank would take this deposit and use it for loans to another person or business. What that ultimately means is money that you put in the bank is now effectively in two places at once. It's in your bank account, but through a loan, someone else has that money. Since it's their money as well, they can spend it on goods and services, or invest it into a business, or possibly invest in the stock market, or a combination of all those activities. The borrower can even deposit her money at another bank, which that bank can then lend out to someone else. Now your money is in three places at once. This is called fractional reserve banking, and it's how the vast majority of money in the world is created. The goldsmiths, just like the modern banker, were giving out more gold claim checks than they had gold. The one major flaw is that it could ultimately create a major financial crisis if everyone with a claim check came back at the same time to demand their gold. The goldsmiths, along with anyone who wanted their gold, would be in big trouble if the assets were depleted. When nearly everyone comes back at the same time to withdraw their assets, they set off a bank run. This may have been the leading cause of the Great Depression, when approximately 9,000 banks failed during the Great Depression, specifically between 1930 and 1933. This led to the loss of $7 billion in depositors' assets and wiped out the savings of millions of Americans. The failures were a significant factor in the economic crisis, compounded by the lack of federal deposit insurance, and the resulting runs on banks as depositors feared their money was unsafe. Bank runs were nothing new by this point. In fact, the goldsmiths had loaned out a lot of gold to King Charles in 1672. Charles needed money because England was at war with the Dutch. Since he was the king, he decided to stop paying the goldsmiths back. Anyone who had deposits with goldsmiths got very nervous, and people in droves went to the goldsmiths and asked for their gold back. And because of fractional reserve banking practices, there wasn't enough gold in reserve. As such, some goldsmiths went bankrupt, and a few were put in debtor's prison, and at least one fled the country. This was precisely the reason the Medici family partners generally avoided lending to royalty, because of the risk of not being repaid and the potential for financial instability. They preferred lending to merchants and other businesses, as it provided more reliable returns and opportunities to control trade routes and markets. Within a couple weeks after the king stopped paying his bills, the Treasury of the Navy instantly became concerned that the money they borrowed wouldn't be recognized, and therefore the Navy would be caught short-handed with worthless notes. One of the important aspects of money is trust. For money to work, the collective society needs to trust that they will be able to buy goods and services with the paper issued by banks in the immediate and long-term future. This is why a lot of people were initially concerned when economies went to fiat currencies, which is a national currency that is not pegged to the price of a commodity such as gold or silver. The value of fiat money is largely based on the public's faith in the currency's issuer, which is normally that country's government or central bank. Goldsmiths, like a lot of other lenders and bankers, often had a bad reputation that was oftentimes undeserved. The church had usury laws on the books for centuries to prevent lenders from making so much money off the public. In fact, concerns about debt goes back to the days of ancient Sumer, as kings implemented clean slate programs to wipe out the debts of the rural poor, because a significant amount of people were so far in debt that they needed to sell their kids into slavery. While there's no record of a widespread uprising in Lagash directly caused by debt, there's ample evidence of debt-related social unrest and reforms in the ancient Near East, including Lagash. Urukagina, the ruler of Lagash around 2400 BC, famously implemented a debt amnesty, releasing people from debt bondage. This suggests that debt was a significant source of social and economic strain, leading to measures like debt forgiveness to maintain stability. Furthermore, it wasn't uncommon for new rulers to issue their clean slate programs when they took the throne to increase their popularity. But also many of these people that were in debt were the rural poor that were needed to harvest the fields and serve in their army. So they couldn't do either if they were in debt bondage. Despite these concerns with default risk and its potential systemic risk to the global economy, banking was necessary for the expansion of commerce. However, unlike goldsmiths of the 1600s, modern banks don't charge a storage fee, but instead pay interest. But debt has become much more central to our modern economies. The percentage of loans likely to default varies significantly depending on the type of loan and the overall economic climate. For example, The default rate for U.S. corporate loans has more than doubled since 2021, reaching 9.2%, a post-financial crisis high. As such, investors have turned to bond ratings to assess the creditworthiness of a bond issuer, as it helps to understand the risk of investing in a particular bond. Ratings essentially predict the likelihood of the issuer defaulting on its debt obligations. This information is crucial for investors to make informed decisions about which bonds to include in their portfolios and to gauge the potential returns and risks associated with each bond. Overall, leveraged loan default rates have also increased, reaching 1.45% at the end of 2024. This idea of taking on debt through fractional reserve banking was initiated by the goldsmiths of Europe. From there, debt markets have evolved and transformed the way global economies work. Whether it's ancient Babylon or the modern international economy, goods and services, along with any research and development, cannot get produced without money. Goldsmiths were able to expand the money supply exponentially, and from there, financial markets, including stock and bond markets, emerged from informal practices around the same time, particularly in Europe. Formal stock exchanges, like the Amsterdam Stock Exchange, followed in the 17th century and have since expanded globally, as modern capital markets are vital for economic growth, enabling businesses and governments to raise funds through stocks and bonds, ultimately driving innovation and investment in areas like medicine, infrastructure, and technology. They facilitate the transfer of capital from savers to those needing it for productive use, supporting a wide range of industries and impacting daily life. The U.S. private debt market, including loans to non-financial corporations and households, is estimated to be around $2 trillion. This private debt market is growing, with some estimates projecting it could reach $2.6 trillion by 2029. The private debt to GDP ratio in the U.S. is currently around 216%. In Canada, private debt accounted for 269% of gross domestic product in 2023. This private debt includes both household debt and corporate debt. The total consumer debt in Canada reached $2.56 trillion in 2024. The European private debt market is a significant and growing asset class. In 2023, the value of private credit in Europe reached $459 billion, representing a substantial increase from $92 billion in 2014. The amount of private debt in Asia-Pacific is growing rapidly as well. While a precise figure for total private debt outstanding in Asia is difficult to pinpoint, the assets under management for Asia-Pacific focused private debt were around $99.3 billion in 2023, up from $58.2 billion in 2020. This represents a substantial increase of over 70% within just a few years. In 2023, private debt in Africa accounted for 54.3% of the continent's total external debt, according to the Private Debt Investor. This amounted to nearly $23 billion. Private creditors held almost $62 billion of Africa's external debt in 2023. Therefore, it is quite clear that debt continues to expand internationally. This debt drives innovation and efficiency. All one has to do is look at the homes they live in, the cars they drive, the public transportation they use, and even the food they eat, and realize this was all driven by debt. It was the Goldsmith bankers that played a crucial role in the development of modern banking, and by extension, the modern debt market. They essentially transitioned from storing and managing gold to issuing paper money and providing loans, which laid the foundation for fractional reserve banking and the expansion of credit. While this transformed our modern economies and therefore funded our current quality of life, there is also a major downside. Humans have been destroying ecosystems and depleting natural resources at an alarming rate while polluting environments across the globe. This in turn has fueled a rise in air and water temperatures internationally, causing man-made climate change. In addition, income inequality in the United States has been a persistent issue as the gap between highest and lowest earners. The gap has been widening considerably since 1980, with the top 1% accumulating a larger share of national income, while the bottom 90% has seen stagnant wage growth. This trend is reflected in both income and wealth inequality, with the wealthy holding a disproportionate share of the nation's assets. In fact, U.S. income inequality is currently at levels not seen since before the Great Depression, with inequality reaching its peak before the 1929 stock market crash. Furthermore, while the days of the robber barons in the Gilded Age saw significant income inequality, modern income inequality in the United States is arguably worse, especially in terms of wealth concentration. The wealth of the richest individuals today, particularly the top 1% surpasses even the Gilded Age peak. In the end, balancing monetary policy aimed at expanding the money supply, with the goal of reducing income inequality, presents a complex challenge. While expansionary monetary policy can stimulate demand and employment, potentially benefiting lower income earners, it can also disproportionately benefit those who hold assets, potentially widening the inequality gap. Thank you for watching the History of Money, Banking, and Trade podcast. If you like what you see and want to donate to the show, you can visit us at patreon.com/historyofmoneybankingtrade or visit our website at moneybankingtrade.com. Also, you can help this show out a ton by liking and subscribing. Thank you for taking your time to watch, as I truly hope you enjoyed this episode.